You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskins, your host as always, and this week is an exciting one. It's the first Brendon Ptolomey episode of the year. People have already been asking for it over Christmas. It doesn't stop, Brendo, the amount of people that ask for you. When's Brendon coming back? It's only been 3 months.
They want the predictions. Thanks for having me, mate.
Thanks for coming back, and thanks for a 7th calendar year.
Yeah,
can you believe that?
I actually can't believe it. I was looking at that on the transcript of the last pod where you mentioned it for the start of 2025. I still can't believe it's 2025. And then, to be 7 years down the track is amazing. Yeah. I really, really thank you for having me on as a guest. And not a day goes by, I reckon, these days where I get a little mention and a little quirk, I reckon, too, in terms of people recognising my voice.
Which is great voice for radio.
Very funny. Even down to old friends from school and that kind of stuff. I was on the beach down south during summer and someone turned around and called out my name. They said, I recognise your voice before I recognise you. So, it's pretty funny. Yeah.
Hey, there you go. Yeah. I was going to say we've both got a bit greyer. I've certainly got grey, but you started grey 7 years ago.
Right, yeah. And now we've moved on from the word grey and we're using white.
White, silver fox. Yeah. Well, let's talk about where we are 7 years down the track in the Perth market quickly. It's nice to look back on what was 2018, the theme of green shoots, and then through COVID it was cautious optimism.
Yeah.
I remember you used those words. Since really 2021, despite various levels of noise up and down in the national commentary space, we've been pretty strong about Western Australia's market, or more specifically Perth's market, and that's what this episode's about, really because we understand and we're looking at the data points, the demand, supply and affordability. They're the three parts of that triangle that govern whether a market's price as a median will go up or down. And really that fundamental has simply gotten tighter and tighter and tighter to what was a diamond created under so much pressure, whether you like it or not, by July 2024. And then we had you in October 2024 to discuss where things were at. Yeah. And it was starting to release a little bit in terms of stock on market. We're going from 3,400 properties on the market to about 5,500 by November.
Yeah.
And you were making that commentary that, hey, there's just a few more options there, but demand is essentially very similar. It's just we're spreading that across a few more properties now, which is not a bad thing. The interesting thing we've noted is something that I foreshadowed on 6PR at the start of December, is that we got to about 5,600 properties on the market as per REWA in early December. And I posited that we're going to see a lot of agents take a holiday over Christmas. However, demand's going to smash on. We won't see any change in demand as long as the properties were available. And we did see that. Going into Christmas, we saw properties on market go from 5,600 down to 4,300 only 2 weeks ago. We're now back at 4,500 as agents start to come back and start to list those properties they've been putting off over time. But it's really interesting to note that we are starting the year again in the mid to low 4,000s, which is just above where we started 2024.
Yeah, and so those total REWA listings, I reckon these numbers are still very, very important for everyone to look at. And in particular, when we have East Coast economists and property commentators looking at our market, I just don't think they spend enough time looking at the REWA data because, as you're suggesting, we've got 4,500 total properties on the market. And this is my new favourite number. I know we had 2,000 houses on the market. Now we've got just under 3,000 houses on the market. So when people are starting to say that supply is returning, that values could go backwards this year, that there's a correction coming, there's no way a correction happens when there's only 3,000 houses available for sale in the Perth metro area.
That's like having 3 bottles of milk on the shelf in Coles.
Yeah, absolutely. Absolutely. So, and to give listeners an idea of where that would have to be for it to be oversupplied, it'd have to be up around 10,000 houses alone with a total listings of about 14 to 15,000. And even then, REWA say that's an equilibrium market. So that would be a well-stocked Perth market. So really just clearly trying to point out to people, we're sitting around about 5,000 at this point in time. It would need to get to 15,000 listings to make the market actually correct properly. Now, to give everyone an example and an insight as to how that would happen, essentially we need population to leave Perth. So if
like happened in 2016.
Exactly. Yep. Yeah. So if everyone stops and thinks about what they think may drive population leaving Perth. Not sure what that event would be. Can't think of one off the top of my head other than world economy imploding, iron ore price absolutely implodes and they close iron ore mines.
Jobs stop. That's essentially why.
Essentially, jobs have to dry up tomorrow.
And that's what happened in 2016 when you think about what happened then, which is actually not the case now. What happened in 2015-16 was Gorgon was finishing.
Yep.
Pluto was finishing, I'm pretty sure. All the big oil and gas jobs that were up there from Chevron and Woodside, a lot of the big BHP, Rio Tinto jobs, all these huge construction jobs that created that massive population growth in the early teens, they left. The jobs stopped. People left.
Yeah, spot on.
I don't want any jobs anymore, right?
Yeah.
That's not what's happening anymore. We don't have those projects. This population growth isn't being supported by those types of projects this time, is it?
No. And so bearing in mind too that when those jobs stopped, and we're talking about construction of iron ore projects, I think at one time we had Rio, BHP and FMG all constructing with Gina about to start her new mines straight after that. So essentially, there's a stat back then from the WA Treasurer that said that 45 to 50,000 Kiwis, just Kiwis, went home in that price correction that we had in our marketplace.
That's 20-something houses that we don't have full anymore.
Yeah, exactly. So, and then the other thing that happened was it wasn't just construction workers going home. It was also all of the engineers that went with that. And so I remember doing valuations on properties, in particular some luxury properties at the higher end of the market that have been executive rented, as in they were achieving premium rents for furnished properties in good locations, and they were vacant overnight because those engineers were relocating to Africa, back to the UK, Canada, exactly, back to the US. If everyone's smell the coffee for 2025, is there an event here that will correct our market into that severe level? And I can't see that happening. The great thing that we do have that happened towards the end of mid to late 2024 is that we've had a correction in one of our mining sectors in terms of lithium, and we can see the effect of that. Really, it demonstrates demand for labour in our marketplace, which again fundamentally underpins what we'll talk about here in terms of the market remaining resilient this year. And that is that most of the people who have come out of that lithium market for needing a job have gone and found a job in adjacent industries. So
it's been absorbed very quickly.
Same with the nickel and copper industry. They've all gone into gold or gone off somewhere else, essentially into new energy technology.
Or Miss Safiotti's construction program as well across Perth, which obviously with the new announcements on the election, we know that the Labor government's going to win the next election very easily. Maybe not as easily as last time, but it's looking like another whitewash. Unfortunately for democracy, you at least want to have a strong opposition, whichever way you sit.
Yep.
There's a lot of promises happening already, hundreds of millions of dollars of capital projects that will be continuing through Western Australia, and that all requires labour, engineers, project managers, people that are going to keep nation building our fantastic city.
Given that we have essentially an unemployment rate that is under control.
The tightest unemployment rate in the country.
Yeah, just leading people through the concepts here. So decent demand for employment. We're actually even pulling people in from not so much interstate but overseas, and one of those would be actually the New Zealanders coming in, which is a live thing. That move from New Zealand to WA is on again at this point in time. Their economy is in more trouble than our East Coast economy. So essentially we're seeing Kiwis come into the WA economy and looking for essentially wage differential to New Zealand. Cost of living is actually better off in WA than it is in Kiwiland.
That's tough to believe, isn't it?
Yeah, which is hard to believe. And then availability of job, but also somewhere to live. Again, which we've been talking about a little bit too much. I think over 2024, there are places to live in WA, and rents are still affordable relative to other markets around the country and into New Zealand.
And around the world.
Yes.
Okay, so we've just spoken there about what I think is important is to try and quantify that downside of what it takes for prices to start going backwards. Stock on market needs to essentially triple. For that to happen, we need to have the borders closed or people leaving. And we say that, we focus on the demand side because we know the struggle on the other side of the equation, which is supply. As much as we keep banging our heads on the furniture, as much as we are willing it to be fixed, we want more throughput, either through economic reasons or through just basic practical limitations of labour. We aren't fixing this supply problem anywhere near as quickly as we would like to be able to, are we? We are only building between 15 and, if we're hopeful this year, 20,000 homes.
Yep.
When we're importing over 90,000 people, those people need 45 to 50,000 homes.
Yep.
We're only building 20.
Yeah.
What do we have to do to get building 35, 40,000 homes if we ever could, which we'd never have.
The official population projections essentially are saying that 52-odd thousand people will come to WA this year. Now, we know from last year's population growth that we ended up at nearly 90,000. So that's a conservative bureaucratic view of where we go with our immigration.
The 50,000 is the plan, isn't it?
Yes. Yeah.
So last year, their plan was 60,000 and we ended up with 90.
Yes. Interestingly, when you pull that apart, 44,000 of those are overseas migration. The balance, the 8-odd thousand, is interstate migration. We know from what Tim Reardon from HIA has said in the past that it's very, very difficult to move skilled tradespeople from the east coast of Australia to WA. We're probably moving, and we know the government's got their $10,000 incentive at the moment.
In the newspapers in Sydney right now.
Yes, yeah, the ads are all over the place. We're trying to attract people without offending them too badly. But we probably have our best chance that we've had in a while in terms of attracting that talent to our state. So what I'm getting back to here is that we need qualified tradespeople in order to be able to create that supply, whether it be single residential housing or built form development. And we do have a chance at some of those tradies creating some supply in that some state government projects will get finished. We will be able to attract some of those tradies from the East Coast because conditions over there won't be the same in 2025 as they have been for the last few years. If you think about the fact that they've been reconstructing because of things like floods in the past, they've got a lot of infrastructure going on. Their cost of living is slightly higher than it is in Perth.
Melbourne's building nothing.
Yes.
Nothing's going on there.
Yeah, exactly. State government will be cancelling those infrastructure builds left, right and centre. Things like the Sydney Metro's being completed, looks amazing. But some of those trades, and we're not talking about wholesale thousands upon thousands of people jumping on a plane and coming here, but we're just talking about the odd number of people that are able to relocate to WA along with the Kiwis to help us with our supply side in terms of constructing residential accommodation.
Let's say that 15 to 20,000 people came across from the East Coast in the next week. Let's just hypothesize, right? The initial thing that would happen there, and I like your commentary too, is obviously that would create massive demand pressure straight away.
Yep.
And let's say we suddenly just gave them all houses somehow. What we're still looking at there is that for them to affect change in our supply, we're still seeing probably 18 to 24 months before they finish building something.
Yes.
Right?
Yep.
They don't just arrive today and it's built tomorrow. So even if we did solve that labour force problem today, there's still the time factor, the lead time to build the thing they've been employed to build in the first place.
Yes.
So that starts to lead me to what I've been saying for a good couple of years now, that even if you start solving these problems practically on the ground or setting up to solve those problems, we still have lead times before the impact is affected.
Yep.
So we start talking about 26, 27, and then we start to roll into breaking down that supply side into the types of supply we get. Now, we've spoken about this before. Of the 15,000 that was supplied to us last year as new dwellings, about 1,000 were apartments.
Yes. Yep.
And the rest was house and land, essentially. Now, what we know is house and land is bursting at the seams. It has economic viability. It does make sense to do it, but they can't do any more of it, either from not enough tractors or not enough zoned land, or the planning environment is too choked up, and this is as much as is being approved at the time, right?
Yes.
So we know that that's about the limit. It's about 14, maybe 15,000 blocks of land can get provided every year.
Yep.
So the rest has to come from apartments, Brendon, doesn't it?
Yeah, exactly. When in some sort of level of built form. So, and we continue. Unfortunately, we haven't solved our issues there just because we went from 24 to 25. It doesn't magically solve itself over Christmas time. We still have an enormous difficulty in terms of viability of those projects, whether they be in outer suburbs or near city suburbs. As we talked about for a lot of last year, the most viable product at the moment is still luxury residential accommodation. That's great that we can get some of those out of the ground.
There's a limit to who can afford that.
Exactly. And so that creates some availability for downsizers and does then create the backflow of them selling their house
on the continuum
to essentially upgrade buyers in the locations that they come from.
What helps us get from 1,000 to 15,000 apartments so that now we're at 30,000 dwellings supplied next year?
What we need is actually value growth in apartments, which we are seeing at this point in time.
So the way to help price pressures slow down is for price pressures to increase.
Unfortunately, that's the answer. Yeah. And so the feasibility being done by apartment developers are getting to the level where they know the rate per square metre per suburb that they can develop to, i.e. what are they going to be able to sell at. They know their costs, obviously, in terms of construction costs and what their margin needs to be. And so they'll now start, I think, 2025, looking around at which of those sites are viable. Hopefully they've done most of their planning work through 23 and 24. It takes a long period of time. Just locally here in North Perth, around the corner from where we're recording, you look at the Celsius guys have been working on a site for 3, 4, 5 years.
Alma Square, 5 years.
Finally getting approval now. It's just so disappointing that it's taken that long. Now their next challenge is...
For 11 stories, Brendon.
Yes. Now their next challenge is they've got to make the thing viable.
Yeah.
So unfortunately the public or the people that complain against density think that the day that planning approval goes in, that the developer's going to make a massive profit. It's all very viable. It's all costed up and ready to go. Guess what? It actually doesn't get costed up until they get their planning approval. They go do some final structural drawings, and then they actually put it out to builders and say, can someone build this thing for us? And in that 5 years that they've been doing that planning for that development, the costs have just continually risen and risen.
Well, it will have gone up 60, 70% in that time.
Yeah,
and
exactly.
The only thing they can do is pass that on to buyers, right?
Yep.
And where that one-bedroom apartment, maybe they were planning to sell it for $450 in COVID.
Yep.
Now it will have to be $600,000-$700,000.
Yeah, exactly. Now, I would probably argue that that's the right value for an apartment in that type of location, because if you compare that to a unit or a single residential dwelling within the location, it's a decent level of discount for that type of product. Where we've got an issue in terms of creating supply in our marketplace in Perth Metro is that it's still very unviable, severely unviable to create density type product in the outer suburbs of Perth. So,
like which suburbs?
So if you go, let's just pick the Ellenbrook train line, and if you tried to create density around those station hubs,
which the government want,
yeah, absolutely,
they're trying to
policy,
incentivize.
Good government policy, great idea.
It is, yeah.
But what we run up against really quickly is the logic of the viability of that, and so
it's not even close, is it?
Yeah, essentially, if you look at a small lot size single residential dwelling close to that station, you're probably talking somewhere between $450,000 and $600,000. Essentially, a 1-bedroom and a 2-bedroom apartment are going to end up costing the consumer the same dollars to live close to the train station, and there's just not the differentiation or the marketplace to be able to develop that type of product and sell it into the market. No developer is going to take that risk in our current marketplace.
Do you think, and this is posing a devil's advocate question here, that the reason is because the house and land industry is there and is more cost effective, that if it was in the absence of that, people would go, yeah, I guess I have to buy an apartment here because this is the cheapest apartment I can buy and it's next to the train station. Hey, it's actually pretty reasonable and life is pretty simple. I mean, that's what you would see in Europe.
Yes.
Only because there was no alternative of house and land. It's just farmland next door.
Yeah, so we have that strange concept of the space available in Perth in terms of being able to do that single residential subdivision type development. And we don't currently have the desperation to get to that level of type of accommodation, but fundamentally we also have a cultural situation where
we all want our backyard.
Yeah, well, and also the people that want to live in those locations, would like their backyard, but also aren't used to the concept of going. So what we really should be ending up there with is multi-generational living in the same suburb, and say maybe mum and dad who are retired are living in the apartment. Maybe the first home buyers are also in the apartment, but the families are all living in a single residential either side of that marketplace. But we haven't matured to that level.
Only because there's an inverse relationship with prices, that the people who need the cheapest accommodation, which is young people who would be happy to live in an apartment, the apartment is the most expensive option.
Yes, yeah.
So it will never work.
Yeah. Right.
So at what point in time does Metronet actually stack up unless the state government goes and sponsors the cost of it itself?
I think some developers would suggest to you that they would need to essentially give away the land around those stations for free.
Land for free and incentives, no development charges. The only way that you're going to see apartments in Ellenbrook, in Henley Brook, along these train lines to justify that density, which, again, great idea. I think we should definitely do it, is if the government literally made it free land, no government charges, and maybe that would stack up.
Probably services connected as well.
Everything ready to go.
Yeah.
And maybe that's what they have to do. And I think great leadership from John Kerry and Rita Saffioti would be, we're going to do it. Let's do it. Here's a builder who we trust, who can get it done, do it properly, no defects, and we're going to make it free for everything that we would have charged you, so that for the next 100, 200 years, these apartments are here and they are actually being used. Yeah,
and you create that supply and then actually create some sort of affordability in there too. Yeah.
I love it. The juices are flowing. Early 2025.
We've solved all the problems now, man.
We have. Let's talk about a problem that has started to rear up in the last couple of months, I think, that is affordability in some suburbs, some areas in Perth, either through just justification of price versus amenity, or hey, this is actually too expensive for me because interest rates are high. I think we're seeing it on both sides now. I think we're seeing at the lower socioeconomic quartile, I'm talking your end of your Armidale line, the end of your Kwinana's, these sort of areas, where prices have risen. They've essentially doubled in 3 years. People are starting to look at that, I think, compared to a little closer to the city and go, oh, I know this is maybe the only thing I could afford now, but surely I can't be paying this now. I can't be paying $650 instead of $350.
Yep.
And then secondly, looking at the most expensive suburb in a local government area, and people are struggling, even though they would like to and have grown up there and will always choose there, are struggling to actually make that happen.
Yep.
That's become a factor, I think, in the last couple of months.
Yes. So in terms of talking about our risks for 2025, those suburbs that you're mentioning, we would use a stock market type term for those, and we think they've probably been oversold. The use of buyer agents, in particular buyer agents based on the East Coast, buying into our marketplace and probably not having the depth of local knowledge that should be available.
Chasing a rental yield.
Yeah, and so they've come into suburbs that, and go back to this time last year, places like Armidale, most of the suburbs through Kwinana, Rockingham and southern Rockingham, so Waikiki, Warnbro, Port Kennedy, all looked really, really cheap. Ellenbrook looked cheap. Baldivis looked really cheap. And so,
but they looked cheap, I think, from a helicopter point of view, where you had no context about the amenity of the area. You're just looking at a map with median house prices.
Yeah, so house price versus rental return. There were some fantastic yields going on through a lot of those locations, and they've equalised now in terms of value growth. From a capital growth point of view, that means that yields doesn't look as good as it used to.
Because rents are starting to really cap out.
Yeah,
people, even though the market's growing the sales side, wages aren't growing that much, and therefore tenants just can't pay anymore, even though there is still tight demand versus supply.
Yep.
We're seeing it in our property management division. Heaps of applications, but the second you go and get a bit greedy as a landlord and ask a bit too much, no applications.
Yes.
Because they just realise I can't pay this.
Yeah, and then they do have one more option to move down the road, or people find other solutions, i.e. they'll start sharing a house, those kinds of things. So
that's why the yield's balancing, because the rent's capping out and prices have come up enough to a point where it's like, well, the yield is actually not that attractive anymore.
Yeah, absolutely. And so that's where we get to this stage of the capital value in some of those suburbs is considered by us to be oversold. There's probably no growth, in all honesty, in places like Armidale, southern parts of Rockingham, in through those suburbs of Kwinana, because you now are up against an affordability or an attraction issue, and so you can go and spend similar amounts of money that those value levels have reached into a slightly better suburb. Might be closer to Perth, might be an older product, might be the next suburb along, but essentially those suburbs have been oversold. They're capped out, and that's about as negative as we're going to get about the 2025 predictions.
Can I balance that question out with one that I think is a paradigm shifter on top of the demand supply that I agree with you on? Is affordability. That's that third part of the triangle.
Yep.
Demand, supply, and affordability caps, which relates essentially to the rule books the banks give us.
Yeah.
Every time that we see the cash rate drop by 25 basis points, someone who makes $100,000 a year will be able to get a loan for $15,000 more.
Yep.
Nothing changes in demand supply that you've just spoken about, and you're saying, some of these lower socioeconomic, lower amenity suburbs have sort of capped out in what we think it really should be worth.
Yep.
But then affordability just starts artificially rising because rates start dropping and people can pay more.
Yep.
Does that shift your view in terms of where that cap sits simply because affordability just lets people float up on prices?
Yeah, so I think those suburbs that we're talking about remain at a certain value level. That's what happened in previous cycles, and that's why they were affordable this time around in terms of being at a low level of value, because there'll be different options to go to, other choices
what you're
to go
saying
to.
Is people start sliding up the amenity curve as their affordability increases rather than just paying more for the same product.
Yeah, and they go looking for other options.
Yep.
So when we talk about apartments, some of those people that were going to spend, say, $600,000 in one of those suburbs, if you come back up the freeway from, say, Rockingham, or even coming back up from Armidale on that southeast corridor, you can end up in, say, a Cannington or a Coburn and buying a pretty decent apartment at those types of value levels, and you've got a different amenity outside your front door as opposed to the single residential option.
I love that, because I wasn't sure what you were going to say, but it lines up exactly with what we've been saying on the podcast over the last month or two, that the theme of this year is going to be amenity. It's going to be people sliding up, grappling up the amenity curve as much as they can, rather than just penting up prices willy-nilly for the sake of it. It will start to be, because supply is a bit larger and there's a bit more choice, and people have equity now, or anyone who's been on the market for a year and a half has equity now to make an upsize, is that people will start making those discerning choices rather than the FOMO choices.
Yes. And I think the other part, a little bit of insight from talking to colleagues, customers, even mortgage brokers, I think what we have here in 2025 is the aha moment of some people. By that I mean they haven't really taken too much notice that they own their own house. A scenario, this is the upgrade buyer scenario. So own their own house or got a minimal mortgage on it, didn't really take much notice of what happened in their suburb in terms of the actual value growth on their own residence. And as an example, we have plenty of suburbs out there that have doubled in value. And so if you had $1 million house, your house is now worth $2 million. And if you didn't take that much notice of the fact that you now own a $2 million property and your equity could be as high as, say, let's say it's $1.75 million, I know the neighbouring suburb's gone up, but you can now use your equity position to move into that neighbouring suburb at a debt level that's probably acceptable, i.e. if you're prepared to max out on debt again and go and take on another $750,000, you are moving suburbs from a $2 million suburb to a $3 million suburb. And I know they're big numbers, and I know people are thinking, but just use $500,000 and $1 million, scale it up or down, whichever way you like. And those scenarios start to play out this year. I think people kind of have their aha moment and go, hang on, I know my suburb went up, but I've just had a valuation done, and you know who to call if you need a valuation done on your house.
You know anyone?
Heron Todd White will be able to help you out. But we can even give you an idea of, even just talk to your local agent. What's my house worth and what are my options into 2025? And I think that will drive a fair bit of the activity that's going on. And that's
driving
activity.
All of it. Yep. I reckon I've been saying this pretty overtly over the last couple of months now on the podcast, on radio. Amenity is the theme this year.
Yep.
For everyone listening, if you haven't already, this is your opportunity. Go check your equity position, especially as interest rates start dropping. This is the next opportunity you will have had since 2020 when the rates dropped to 2%.
Yep.
Where you, first time in 5 years, you'll have had to move up the amenity curve, to move up the socio-demographic ladder, because for the last 3 years since rates have gone up, you've essentially just been trying to keep your head above water.
Yep.
And grappling to have a roof over your head, that access, affordability themes I've spoken about over the last couple of years. This year is that first chance again to use your equity, use the dropping interest rates that we assume are coming at some point this year to be able to make the jump.
Yeah, just given our activity over late December, early January, to give people a flavour of what's been happening in that refinance type marketplace and the mortgage type marketplace. So we had the lowest volume we've had in between Christmas and New Year in quite a number of years. So here we are coming off a really busy 2025. Our impression at looking at our data in terms of daily job numbers coming through our doors is that essentially brokers and bankers put the queue in the rack, and probably real estate agents to an extent as well, put the queue in the rack in about mid-December.
Just fatigue.
Pretty much a week out from Christmas. Massive fatigue, looked at the days off that they could have. A lot of them, I think, came back last week in terms of 6th of January. But our job numbers, as of second week of January, are back to nearly 85% of our full volume. So, i.e., activity is already back at 85%. The reason I'm raising this is that I think that there's a bit of a backlog around in terms of banks processing and those kinds of scenarios. And I'd be encouraging people, if they're thinking about refinancing or thinking about talking to their broker, to pick up the phone and do that sooner rather than later, in terms of getting prepared for what might come in terms of a rate cut through, best case scenario is obviously February. The market's saying there's about a 75% chance of that. Latest inflation data looks pretty good in terms of RBA making that change. And if you are anyone in the RBA and you've got Albo looking over your shoulder or directly in your eyes saying, I really need a favour here, can you please cut rates as soon as possible? Let's see what happens.
I reckon it's line ball, mate. I reckon
it's very line ball.
I think there's a lot of optimism in the bet.
Yeah.
I think people want the bet to be true as well.
Yeah.
I hate to be a negative Nelly here, but I actually think we're not there yet.
Yeah. And I think
a lot of people want it to be the case.
Yeah.
But especially with our Forex at the moment, things are going to get more expensive if we actually drop our rates, drop our cash rate, because we import most of the things that we have. But look, it may happen in February.
Yeah.
Do you have a view as to how many times it will happen this year?
So not disagreeing with the February thing, I think clearly the RBA are a conservative organisation, so why would they make a outlandish call to start the year? It's easy just to wait to March or April. Unfortunately, yeah, I mean, at some point in time we were talking about maybe 4 rate cuts. There's more talk around there just being 2. Unfortunately, I think it gets really difficult to pick whether it's more than 2 just based on Trump hitting the White House and the chaos that can follow that. Who would want to be an economist in 2025 with that occurring? We're talking about a person that just wakes up and makes decisions off the cuff, off the hip, every single day that could have effects on the world economy. So, yeah, I would expect probably 2 rate cuts for the year.
So if you think about the way that affects affordability and being able to get a larger loan, every time you drop by 0.25%, your affordability goes up by about 3%.
Yep.
So I'd like to think there, if you're saying that there's 2 of them, that 6% of this year's growth is just going to be artificial in affordability increases from the banks, right?
Yep.
So we're already starting at 6, in my opinion. 6 is our baseline. If we're going to have 2 rate cuts, we're 50 basis points down. We're just going to be 6 points up without any effect from demand and supply.
Yep.
And then it's a yeehaw from there along the roller coaster.
Yeah.
And that's why my view is that we will be in the teens this year. We'll at least be seeing 1% every month on average, and anywhere up from that based on how interest rates scale from 2 to 3 to 4 if it did happen.
Yep.
But again, a lot of volatility in this market, especially coming out of America. More people than I remember through all the social media hotlines and YouTube and all this calling some cataclysmic event in the economy. More people in Bitcoin, more people in gold. There's a lot of people nervous about when the market's going to have some sort of crash.
Yeah.
But where there is chaos, there is opportunity. And what we also know about Perth is whenever there is a crash, we are the safe haven. We've spoken about it before with COVID. People come back to Perth for family, for jobs, for safety. We're the most isolated city in the world, and everyone needs our minerals to start nation building again, because most people will start dropping interest rates again.
Yeah.
So I'm not too concerned if we do have some sort of global event. I'm actually thinking that will probably be good for Perth, just like it has been every single time it happens.
We didn't do too bad on the back end of the GFC as well for a while there.
Exactly.
Yeah. So, in terms of our thoughts on market growth, if we're talking about median house value growing, certainly we think we're up around the 10%. Conservative valuers, we don't want to go too far on the crystal ball, but I probably would shout out some of the East Coast commentators that are talking as low as 2 and 3% for Perth. I think they probably haven't got their finger on the pulse and are distracted by some of the data and the insights on the East Coast and how Sydney and Melbourne are going.
Projecting their lives onto Perth without having any real understanding of Perth.
Yep. And then I go back to that population growth. As long as we've got population growth pressure, then I expect that we'll have value growth
because
as well.
Because the supply side can't match it.
Yep. Yeah.
Essentially.
And it, there's just going into the other fundamentals, but unemployment is fine as long as people are keeping their jobs. It means that we don't get a wholesale dump of supply into our marketplace. So there's other factors there as well in terms of the broader economy just running at a really steady rate. The only other thing I think dampens our outlook for the year, and this comes down to activity, is that people get nervous around either side of an election. And unfortunately, this year we will have a state election followed by a federal election.
So you do see some stasis occurring in March, April?
Yeah, so fundamentally you get a few weekends there that people are distracted and where people won't make a decision because they think that they're some sort of event that might happen that
there's a lot of noise.
Know the risk. Yeah. That will to a degree be a factor that's removed slightly by the fact that we literally do know that the Labor Party will win the next state election. It's pretty much impossible for the Libs to take power, and so that gives you some certainty that things will continue the way they are in terms of state government policy. Yeah,
and I think that's probably more important than the federals. Whether Liberal or Labor gets in the Fed side, but we have them by the nuts either way in terms of GST, in terms of investment into this state, simply because they need us either way. And a lot of commitments are being made for Western Australia by both sides just for one of them to get in, right?
Yeah.
So I think it's a win-win for us, whether we have a Labor or a Liberal, a left or a right side of federal government. We already know where the state government is going to be sitting.
Yeah. Culturally, Perth and Western Australia more broadly are desperate for attention and approval. And it's very much a case of, yet again, as it was in the last federal election, that we will get plenty of attention from both major parties.
So we've both spoken there. Somewhere in the teens, somewhere with a 1 in front of it is probably where we think the median house price is going to be ending up, right?
Yep.
We know that last year, the span of suburban median house price growth was essentially from Camillo at 40%. like unbelievable,
Yes.
40% for
Yeah,
Camillo, to places like South Perth at -2%, which most people wouldn't realise does happen when you have a growing median across Perth. There are 4 or 5 suburbs every time that aren't, just on the numbers, aren't doing well. And that again speaks to suburbs like that capping out on affordability, not changes of amenity. People just, with interest rates being so high relative to their incomes, these are the places that struggle a little bit to move with the pressure.
Yep.
But going into this year, with the impact of affordability starting to loosen a bit with rates hopefully dropping, what do you think the dynamic is as to who the winners are at a more granular suburban level this year? You've spoken about amenity. Do you have some rings, some circles, some hotspots of where you think that amenity goes to and isn't capped? We could all just say, western suburbs that has the most amenity.
Yeah.
But that probably somewhere in the second quartile that's getting most of the look in this time, because the first quartile, the western suburbs, less impacted by affordability. They run on jobs, on whether people want to be here or not.
Yep.
Business success, and we've had enough of that for many years now in Perth since COVID. The second quartile is those people who wish they were first quartile. So people who are rolling around on Instagram presenting a life that's better than the one they actually have. They have car loans on the Range Rovers and all this. But these are the ones who are most impacted, I think, and most aspirational at the same time when it comes to debt.
Yep.
So the second you loosen debt, these are pretty switched on people, but just don't have the buckets of money that the first quartile have.
Yep.
So they're impacted massively, but they're still going to push up and chase that amenity as quick as they can. So for me, it's places in that second quartile that I think will see most of the pressure this year.
Yeah, I think that to begin with, so those upgrade buyers, they're only going to move if lifestyle and amenity changes. So in the near city suburbs, that is getting into places like Mount Hawthorn, Mount Lawley, even over the better sections of Vic Park and into South Perth. So I'm just doing a quick lap of the river, go down into, and again, we're at a different level in terms of tiers of value, but Applecross, Utterdale through those, and Mount Pleasant through those locations. So the amenity in those areas around near city locations with restaurants, cafes, plus the old style infrastructure of schools, education, transport links are all still really good. So then what I think one of the interesting things to watch change over the last few years is the strip shopping centres that have been updated and caught up to what the demand for lifestyle is. And my favourite examples is my old stomping ground through kind of Scarborough and into Doubleview. So you go up the hill of Scarborough Road in Doubleview there now. There's multiple cafes, there's multiple small bars. They're packed, whether it's breakfast, lunch or dinner. When I grew up through those suburbs, admittedly a number of years ago, we got to a stage in those suburbs where they were just useless shops, and potentially it was, so they've gone from being the local supermarket and local deli to not being a viable retail operation anymore, and everyone was looking at each other going, what do we do with these things now? Do we knock them down? And thankfully they've been rejuvenated and repurposed. But they're examples to me, and everyone will have their favourite example of their new local cafe and new local small bar in their area that creates that viability for the location and the desirability in terms of that amenity of lifestyle.
The walk score.
The absolute go back to the good old planning walk score. If it's within about a K of your house, then you're going to go and use it, and it doesn't matter how old you are. You might be retired, or you might have a brand new family, or you might be empty nesting couple at either end of that age group, and essentially you want to get out and about and enjoy life, and that's what's down the road within a kilometre. Yeah.
So you're on the same page with me then?
Yeah, absolutely.
This is where we're going to start seeing pressure.
Yep, yeah. And I think where we see the greatest value growth there is, these are a kind of low-hanging fruit in terms of examples, but you go east coast of Marmion Avenue to west coast. So you've made some good money on the east coast of Marmion Ave, and you go that
Padbury
lifestyle.
to Hillary's.
Yeah, exactly. Yep. Padbury to Hillary's is easy. You're cashing out of Padbury at least $1 million. You've been there for a number of years. You've minimised your debt, and you're taking that $1 million to drop it on maybe $2 million in Hillary's.
And getting debt again. Yep.
Let's not get caught up too much in the numbers. I know I'm throwing around numbers easily, but they are the scenarios that people will be considering. Yeah.
Yep. I think that's really good insights, and I hope a lot of people listening will be nodding their heads going, yeah, this is really starting to make sense to me now. We've listened to these episodes over the last few weeks. Trent's interviewing a number of experts. They're all coming out with pretty similar outcomes here, as this is where the money should be going this year. because why wouldn't it? This is human nature. We're all trying to get somewhere we would rather be, and I think this is the first time for a while now that the opportunity is opening up. So take it, do it before interest rates start dropping if you can. Certainly do it in the election period, because we do know historically people get a little bit numb and static in that time as well. So there's opportunities to jump in if you didn't get in over Christmas like we advised people to do, because pretty much every month now the procrastination that continues for a lot of people looking to move and upsize and make that perfect purchase is costing you 1% to 2% every single month.
Yep.
If you're buying property in a 7-figure situation there, it's $10,000 to $20,000 every single month. Stop dilly-dallying around, pull the trigger, make the move.
Yeah, I know we've talked a lot about supply, but as a little bit more availability comes into the marketplace, that is your opportunity to choose something.
Yeah,
so
less friction
instead of
in the
having
market.
one house to choose from, you may now have 2 or 3 houses to choose from. That doesn't mean values are going to go down tomorrow, as we've just talked through.
Yeah.
So just take the opportunity to have some choice and potentially be competing with less people when you're buying a house.
I actually think that's a really positive, and I think we'll leave on that note, is the mobility in the market is also a thing that will happen this year. More mobility, because if we're moving to 5,000-6,000 properties on the market, which again, way undersupplied, but still way better than 3,500, you just start to notice that people have more ability to make that choice, but also from the top down of downsizers. The downsizer finally has somewhere to move.
Yep.
And then all the way down the continuum, you've just freed up everyone moving along the domino line there, right?
Yeah.
So if we can start seeing that happening, everyone else starts to enjoy the benefits of that, I think, along the way. And I think this is the first year we're going to start to see that come into place, where everyone's still winning, but actually being able to make the move.
Yeah, and they have that, it's exploiting the opportunity that comes in 2025.
Thanks, Brendo. Have a really good first quarter. I know we'll be speaking in April, but this, I think, as we have seen for the last 5 years, this quarter is going to be an absolute smasher. So I'm looking forward to hearing some good data points from you on some sales that have started to be valued over the next couple of months.
Yeah, cheers, Trent. Thanks for having me, man.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!